Podcast is now starting. All attendees are in listen-only mode.
Welcome, everyone. This is Chris. Thank you for joining us. Today is Tuesday, December the 4th, and I hope you all had a wonderful Thanksgiving holiday, and I wish all of you happy holidays coming up. Before we get started, I just wanted to spend just a moment of silence and respect for the passing of President Bush and his service tomorrow. As a reminder, we want to be your 30-second solution. We want to be your visual answer to the marketplace. We want to also remind you that we are not bullish or bearish, other than we're bullish on opportunities. Like I've shared before, I think wearing a strong perma bull or perma bear hat can be dangerous over long terms because you can get caught by surprise when trends change, and we're trying to help you in many ways to keep an open mind and show you potential key inflection points. I'm going to continue to bang the drum of this because I think this is the dominant theme of 2018, or what seems to be impacting the markets a lot. I know we hear all kinds of news stories, and is the Fed raising rates too much, economy slowing down, tariffs, all kinds of things. I still continue to not understand humbly everyone why, but I totally believe that the markets continue to be influenced by the emotional highs of 2007 and 9. This is a reminder that the highs in 2007 and 9, when applied the 161 Fibonacci extension level of those really emotional highs and lows of 07 and 09, the market chopped sideways for over 15 months. There's certain ways you can look at it. It was closer to 20 months. You start using certain monthly patterns. But this is a monthly line chart. You can see that it banged up against the 161. And in time, we see it made a W bottom, broke above it, finally came back down to kiss old resistance as new support, and then it blasted off 50% in about a year. So this is something that was obviously important to mentally recognize. It was important for your strategy to know, hey, this is a time to back off. Living in Kansas, in the winter, and then it happens many places around the world, that we all know that if there's some snow and ice out there, it doesn't mean you can't get to your destination, but it's probably advisable to drive a little slower. So if you can, my intent is to empower you to the odds of what could take place. It's because of this pattern of a few years ago that's influenced me to start sharing on February the 28th, essentially March the 1st, that we should be empowered by realizing that we're probably going to have a choppy market for a while, and how you can take advantage of those markets by smaller trades, just backing away and relaxing through that situation. So the one thing that I recognized early this year, folks, is I want you to look. I know this 4-pack looks busy, but in the upper left is the S&P 500, the Dow here in the upper right, the NASDAQ Qs, the QQQ ETF, and the Dow Transportation, average in the lower right. So I know I've been in this business 38 years, but it doesn't matter if I've been in it 38 years or you've been watching the markets for 5 years or 68 years. We all have the same opportunity to look backwards. And in looking backwards over my 38 years of experience, and even trying to look further back, I don't think I've ever seen such a cluster of key markets pushing up against Fibonacci extension levels based upon some of the most important turning points. And so this is a reminder, the S&P is up against the 261 level. The Dow is also up against the 261 level. Look at this, the NASDAQ is up against the 161 level based upon the 1999 high and the 2003 low, or experience a 90% decline. Transports, if we take the lows of 03, and you can see the highs, or like the neckline of this inverse head and shoulders, it's up against the 261. And while the 261s are in play, if you look at the charts where I've applied the monthly momentum, you can see that in these blue circles on top of each chart, folks, another reason that I just wanted to say, hey, folks, this is probably an 800-pound gorilla, and you should respect how heavy it is to try to get past these levels. Part of the reason was look at monthly momentum, folks. Like I said, it doesn't matter how long that you've been in the business. This is monthly momentum that if you'd look back clear to the 1920s, very rarely has it ever been up this high. So you take a combination of overbought from a momentum perspective. Later on, we'll discuss some traditional valuations, the Buffett indicator off the Richter scale, and these extension levels we still have to respect. It doesn't mean a bear market has to start, folks. And so far, what has this year entailed? A back and forth action and essentially a 10% range. I know lately when we had the decline a couple of weeks ago, it was really easy to find a lot of people discussing the sky was falling. And I think we really need to me, if it is falling in price, I think we're going to know it. But to me, when we're still above the February highs, people may not like the price action of certain things going on, but to me, that's more probably of an attitude or a position versus an actuality in price. So this was the message that was shared early this year, and in the yellow box, essentially, just we're suggesting capital preservation could be important. You know, this is a very humbling business. I don't know that I've proven that we've been right. You know, in that call, cash has outpaced the majority of assets. And one thing I wanted to be a reminder of, even take like we owned Apple for a while on a breakout. We made some really nice gains. We harvested the gains. We raised the stops. And now Apple is off 20 or 25% in a pretty short order. And so I want you to keep in mind that, let's just say it was a 20% decline only. We've now been able to purchase what? From the time that we sold Apple to now, we could take the same amount of cash and buy 20% more of Apple than a few weeks back. So in market declines, please count the victories of gaining of purchasing power. You know, when the S&P fell 50% from 2000 to 03 and 07 to 09, if you avoided that, you gained 100% in purchasing power. So these are really important, folks, to recognize when the roads are slick, when you need to slow down, back off, smaller trades, keep your risk low, and just let the world beat themselves up while these time frames are going on. This is a chart that reflects from Bloomberg and Deutsche Bank the number of assets with a negative return in any given year going back, what, 120 years, everyone? So I first want you to look, okay, this is in US dollar terms. So in other words, if these assets were outside the United States, the dollar rally has made things worse, or on the right chart is in local terms, in US dollar terms. The bottom line is, let's start at the bottom. At the beginning of this year, look, folks, the number of assets that were experiencing negative returns was 1%. In US dollar, in US non-US dollar terms. In local terms, it was 15. So that was really towards the low end of things, and wow, how things can change in just less than a year. So in non-US dollar terms, you can see that almost 90% of the assets have a negative return, and in local terms, it's around 61%. And regardless of which table you look at, this is rarefied air. Hardly any time, you know, I can share this. I've shared it a few times, but I'll repeat it. You know, in my 38 years, there's been very few times that diversification, or in other words, spreading of the assets, has been rather unrewarding. You know, where's the teeter-totter effect? Let's see, one asset goes up, I know that this other one should go down. I'm going to diversify. I'll keep these opposite movers, and now both of them, the teeter-totter's broken. They're both going down. So this has been a painful year for traditional asset allocation models. And, you know, I can't help but think, folks, that 261 Fibonacci extension level has a ton to do with it. So in staying with our theme, there's always some good, some bad, and some ugly. So I want to start out with the good and just go back 30 days ago as a reminder. 30 days ago, when the market was going down into the end of October, people were piling money. This red arrow was pointing at, they were piling money into the RightX Bear Fund. This chart reflects that we look at the amount of money flowing into T-bills. It was just flooding into T-bills because people were panicky. This was from 30 days ago. This is the spread between optimism and pessimism indicators at Sentiment Trader, and you can see how low that this was. And typically when this is low, it's reflecting that a lot of people are pessimistic. There's not very many indicators that are optimistic, so it's a contrary indicator. And you'll notice in the green shades, when it's down this level, the market is typically closer to a low than a high. But it wasn't very long ago, folks, this was the polar opposite, and here came this decline in the month of partially September and October. So think about a month ago, money's flowing into bear funds, money's flowing into T-bills. This spread is low. What would you bet would take place over the following 30 days? And so this was prior to today. This was the total return of the S&P 500 and its sector funds over, see the blue box up here, everyone, over the last month. So there's only one negative, communication services. The S&P was up to almost 250 basis points, almost 2.5%. You can see with energy was what the lagger of the smallest of the seven dwarfs, with the biggest gains coming in healthcare. We see in real estate were high. So this is what we were trying to share a month ago, that in the short term there was a lot of pessimism in play, and to not be surprised on a short-term bounce. And so, as you know, in these webinars, we're going to look at some of the things that are taking place in the last 30 days, and we're also going to get in a plane or spaceship and look down on 30 and 70-year patterns as well, to try to give you perspective to empower you the most on both sides. So let's turn forward. These are current levels. This is again, we're looking at the optimism-pessimism spread. You can see that it's still towards the lower end of the range. It's near the extreme pessimistic level or extreme pessimism level. And from a short-term basis, again, this is typically where markets are closer to the low than the high. I want to highlight and just kind of discuss. Here was the trading range at the 161 level that we talked about early in the presentation, where the markets chopped sideways for a year and a half to almost 2, and you can see how the optimism spreads worked during that time. As it got towards the top of the range, no surprise, you can see where the indicator was. Towards the tradable or the lows of the range at that time, you can see that there was a lot of pessimism. And folks, it has a lot of look at a lot of similarities to now, versus right below the 261 level, as it does below the 161 level. So I know it may not be necessarily easy to think back on those times, but there's a lot of parallels, folks. I don't think bulls have a lot to brag about this year. I don't think bears have a lot to brag about this year. When this trading range finally resolves itself to the upside or downside, there's probably going to be some pretty large movement. And this so far is an upper level base being built in a longer term uptrend. That's what the 161 level was. Once it broke out to the upside, had a 50% gain in a little over a year. Now we've got a sideways, movement again. You can make a case. Whoops, looks like a double top. Whoops, looks like a double bottom. Folks, there's don't try to get too caught up on what this is, other than to expect almost a gerbil in a cage mentality. The whipsaw, the schizophrenic back and forth action, and then the news media trying to find a reason or excuse. Yesterday's big rally was because of the tariffs with China over the weekend, and then today was what? It's when we look back on charts, who cares what was making these declines happen, or what the so-called event of the day was? It's just all about the patterns and the price at hand. I changed the screen on you. This is the flip side. This is smart money, dumb money confidence spread. When this indicator is high, it's reflecting that the smart money is rather confident and the dumb money is scared. And so again, I compared the trading ranges, and you can see currently that the smart money, dumb money spread is lofty, that so far over the last several years or out through most of history, markets are short-term closer to lows than highs when these indicators are where they are. The fear greed index through yesterday, I don't have it through today. I could see it, the little speedometer might have changed some. If you remember, a month ago, it was at 8. So that was the time frame when I was trying to just express to you with all those outflows and stuff that people were a little bit pessimistic while you're still inside of a trading range and above the lows of February. And so market's not cocky. You can see it's at the 32 level. It's just not as fearful as it was a month ago. We can see today's market action with the Dow down about 800. I bet that little speedometer went to, that number is a little smaller. Just a reminder of the smart money, dumb money confidence spread is rather high when the smart money is feeling good about things. Typically the market's close to a low. And the flip side is when the dumb money is really cocky, that's when the markets are closer to a high. So we have quite a spread right now. So on a short-term basis, again, these sentiment indicators suggest that we're closer to a short-term low than a high. Just a reminder from a good friend Ryan Dietrich that typically, we're under the good news section, that typically tis the season that markets generally rally this time of year, with the average rally from the October low over what the last 65 years during a midterm election is about 10%. So we were looking like we were getting towards 10% yesterday, a lot closer, and 250 basis points were chipped away, today. Another reminder of that the gains typically take place in a midterm election at the end of the year. And again, this was from good friend Ryan Dietrich. Excuse me. I published this chart this weekend, and it was just highlighting what patterns looked like in 2007. It highlighted also it was kind of a catch-all chart. It highlighted the 161 level. It highlights the rising channel that for the past 7-8 years, the S&P spent the majority of its lifetime inside this blue rising channel. You can see it hit the 161 level here, chopped sideways for months and months and months, came back and tested this channel twice as support. Then once it tested old resistance, 161 level, as new support, it took off to the upside. So now we got the 261 level. So folks, it's been really easy to, there's a lot of comparisons or similarities between 2007. I think we're driving a little fast on an icy road if you want to try to ignore that. But on the flip side, when a lot of people are talking about the sky is falling and how we're in this giant bear market, I don't know what I'm missing, everyone. Prices are down from 6 weeks ago, but they're up from 9 months ago. And so to me, again, the sky's falling sideways. We're just in this choppy market. And again, the longer, it built an upper level base right here to blast off from until we start breaking support. You have to give the odds over the 50% chance line that it's just doing the same thing similar. And then so many of the game changes would happen if you start breaking below the February, lows, the February lows of this year. So just as a reminder, here are those 800-pound resistance lines at each one. The blue shaded boxes are the trading ranges that multiple indices are experiencing for the last 12 to 18 months. And then you see a steep rising support line just under the number, or just above the number 2. And so folks, I think, again, the trend is still up. This sideways action, sideways chop for 12 to 15 months has not broken these long-term trends. But I draw these out to let you know that someday these could break. And if they do, I think you can buy stocks a lot cheaper than current values. So you just need to know, according to your own risk levels, what type of risk tolerances do I have and how flexible can I be with my monies. So those were the good things. We'll move from the good to somewhat bad vibes, bad news. We've shared this every week in the sectors report. This is the semiconductor index off the 2009 low. This index has been much stronger than the broad market. So you can see that it spent the majority of the last 3 years inside the blue or the light green shaded channel 1. You can see this is the choppy action for the last year. You can see it broke down below the channel, which is definitely a negative. It came up and kissed the underneath side of the channel and of the lows over the last year, backed off, and then as of yesterday, in the when the market was up, what was it, folks, 400 points at one time, you can see the notch on the left of this week's price action was the opening. In other words, what this chart is sharing us, folks, that the opening was kissing the underside of that channel, attempting to break above this blue line at the 97.66 level, which is 2018 lows, and then you can just see a dramatic reversal taking place. And so from a technical perspective, doesn't matter what the asset is, folks, let's just forget that we don't know. We're just looking at the worst thing that an asset can do, or a nightmarish scenario is to break horizontal or rising or both channel resistance, break down and come back and try to be the little train that could. Try to get back above those dual resistance lines, and then selling, heavy selling takes place. So to me, one of the most concerning, this is one of the worst places in years for semiconductors if selling would take place at 2. So keep a really close eye on what semiconductors, if they start selling off below 97 and break back below the lows of a few weeks ago, like in the 88 range, this tech sector is going to send a negative message to the broad market. This looks at the QQQ. Again, we applied Fibonacci to the 2000 high, 2003 low. You can see it hit the 161 level at 1. Again, folks, we have another 800-pound gorilla up here. We see a hanging man pattern right here a couple of months ago. Tech has backed off. This is a monthly chart, folks. The last 2 months have shown some tendencies. They're showing bullish reversal wicks right at dual support. That's a positive for tech. Again, the trend on tech is still up, just sideways chop again for several months. Where the concerning message to leadership, again, tech has done much better since the 09 lows over the S&P. If tech would break dual support at 2, that would send a really concerning message to tech and the broad market. So keep the 160 level. Much movement below 160 could go from uglier to fugly in the tech sector. 30,000 foot view on the S&P 500. This reflects that it has spent the majority of the last 3 decades inside of rising channel 1, or excuse me, rising channel A, the blue shaded area. What I wanted to highlight is what did the price action in 2000 and 2007 look like? Obviously in 2000, it was kissing the top of this channel with monthly momentum that was creating lower highs. We see the same thing in 07. This is the 10-month, almost the 1-year moving average. So when rising support and the moving average broke with negative diverging momentum in play, big sell-off took place in 2003. We see the same type of pattern once the dual break took place in 07. You can see that it came back down to the bottom of the channel. 9-year rally, we're back to the top, testing rising support and the long-term moving average at 2 with momentum diverging to the downside. So again, the long-term trend is up, folks. If it would break rising support at 2 and below the February lows, the S&P 500 would definitely send a long-term message that you can probably buy stocks at a much cheaper price down the road. This is our divergence 4-pack. The upper left is home construction index, upper right is banks, lower left is junk bonds, and lower right is the S&P with momentum applied. Just a quick reminder, so much of this smells like '07 and 2000. So you can see in '07 that home construction started heading down. I think it lost, what, folks, like 60% prior to the S&P turning lower. So far year to date, home builders are off 20. So the divergence at this time is not as big, but it's still a bearish divergence taking place. Banks are diverging again the same as they did in the '07 highs. Junk bonds, and I forgot to show the 2007 divergence here, but they diverged for a couple of years prior to the 2000 peak. They diverged again in 2007 before that peak, and they've been diverging again for over a year. So these are all, this is not new news to any of you. We've been sharing this for months. Just want to update these. And then this is the S&P 500, which shows a negative divergence in momentum. As it was making lower highs, the market was making nominal new highs in '07, and we see the same thing, this year. So we are, all of this doesn't mean that any of the trading ranges have changed. It's a reminder that these divergences were a tip-off months ago to the likelihood that most asset allocations and diversification will struggle, especially, in the equity index. So again, these divergences remain influential to the markets and something that should not be ignored. This is a reminder of the home construction index. Just this year, how much the patterns look the same. You can see a bearish descending triangle. Once that broke and won, they fell apart, and the broad market did too. We see a similar bearish descending triangle taking place. And so if we would see home builders break support here at 2, and the S&P break below the February lows at 3, that would really send a, hey, you can buy me cheaper later, just be patient, folks, message. So moving on to the ugly, this is a reminder of the power or the influence or what typically follows hanging man patterns. This is the NYSE index, and back in 2000, it made a hanging man pattern here. You can see a large decline of 35.40. See another hanging man pattern at 2007 highs, 50 plus decline, 22 plus decline. So in February, we saw a hanging man pattern take place in this index. That's when we suggested that capital preservation, just get back, get away from the market, maybe in mostly cash. You can see that this broad market has been choppy. It remains in a range, and the lows of February are strong support so far, folks. There's no doubt about it. We have another trading range taking place. But if the lows, this index is, as the S&P is closer to the top of this year's trading range, there's no doubt the NYSE is reflecting relative weakness because it's been closer to the lows several times and still is. So again, if the NYSE breaks below the February lows, the message is you can buy stocks cheaper downstream. This is just a reminder of a close-up look at the junk bonds, same chart as we had earlier, but just a reminder of almost a 2-year divergence here, 7-month divergence here in '07 peaks. We've had over a 12-month divergence taking place, right now. And so these are all divergences that are suggesting that the foundation is not as stable underneath, or as Ross Perot, that ran against George Bush in the '80s. He used to say you need to lift up the hood and look underneath. And so this is lifting up the hood and reflecting there's some oil leaks. You're hearing some lifters and different things ticking and making noise in the engine that's not real healthy. This is a reminder of the bank index, folks. Looking back 25 years, nothing more than a giant trading range. Double bottom took place in '94 and 2009, the financial crisis. And so far, it looks like we have a double top at the top of the trading range, or the 2007 highs earlier this year. So when banks were at this level and they broke multi-year support in '07, that's when things started unwinding for the banking system and the broad market. We see momentum, folks, is just as high, if not higher of late. That's a negative to see it rolling over, and now it's breaking 3 to 4 year support here recently. And so again, these are ugly messages to the long equity side, but they're beautiful messages for being in cash and watching the ability to gain purchasing power come to you. And that's what this is about, right now, folks. One of the things I've been trying to hit on for quite a while is just that the key inflection points that interest rates are facing. They're facing 20 and 30-year falling resistance. At the same time, these potential topping patterns and bearish divergences are taking place in stocks. And for quite some time, I've tried to make the case, probably poorly, but I'll try to make it again, is that, in my opinion, if interest rates would turn down while they're facing 30-year resistance, that would most likely be a negative message for stocks. Bonds tend to trade a lot on reality. Stocks tend to trade a lot on speculation. And so as we've seen this large interest rate rally over the last 4 years, I think the 5-year yield, folks, I know it's coming off extremely low levels, but this number is fun to talk about. The yield's up 1,200% in 5 years. That's a big increase, even off of low levels. And it's taken it up to falling resistance. And so, folks, here is something that I do not think is good for stocks, and that's where you see in 2000, when interest rates rolled over at resistance, stocks did the same. 2007, stocks did the same, rolled over again. Folks, I don't know. I know conditions. Most of you know I live in Kansas. A good time of the year, certain type of conditions start taking place. Those conditions are warm air, humidity, and cold air. So if we have a lot of moisture in the system and it's a real warm day and a good old cold front starts ripping in from Colorado, it's not a winter storm, but it's just a cool front that comes in. Those ingredients, when we know those are around, we don't stop our day, but we become highly aware that those conditions are, when a tornado forms, those are its conditions that are needed, to form. And so I'm trying to share this, that I really believe that through almost 4 decades of experience, that this is a price point that conditions are in play, that lower interest rates, we're going to find out in time, are actually going to be bad for stocks in the world that we live in, right now. So along that line, here's a canary in a coal mine that's really jumped out the last couple of days, and we just kind of move aside from stocks and just talk about bonds for a minute. But this is just a reminder. This is going back to the mid-60s. This is a really long-term chart of interest rates. And folks, just as a reminder, rates are just in this long-term downtrend. We have seen an extremely sharp rally over the last 4 years, but so far all the rally has done is go back to the top of the trading range, and it has the potential that it's forming a bearish rising wedge, which 65% of the time suggests that asset will fall. You can see when it was close to the top of the trading range in 2000 and in 2007, rising wedges took place. Yields broke below support. Stocks followed to the downside. And as I wrote in yesterday's sectors report, this is always so fun for me. Folks, I can't answer it. It's the chicken or the egg scenario. I know I put these charts out there, and a lot of people say, well, Chris, yields will drop if stocks decline, and then money will flow to bonds. And there's not one darn thing wrong with that argument. We've seen that happen before. Have rates ever turned down before stocks? And so then were there ever times that bonds were the leaders? That's happened too. So it's not a Hatfield-McCoy debate, folks, whether one's got to come before the other. If you start seeing both at the same time, it does suggest if yields start falling and stocks start breaking support, it's an environment of risk off. And so as we're looking at, I like having fun, folks. We got to stretch all of our own minds. These are interest rates, 2-year yield in the upper left, 5-year upper right, 10-year in the lower left, and 30 in the lower right. But I inverted the yields to look like bond prices. So we could just talk about bonds for a minute. So if you think about it now, the 2-year yield, folks, has been on support for how long? 30 some years, since the 80s. since the 90s, 5 years have been, this is the bull market support. And same thing for the 10-year in the lower left. This is a support line. 30-year, this is a support line. You know, and the last 2 times, you see the 30 tagged it a few more times, but at key inflection points in the stock market, yields were testing this support line in 2007. And so the large declines you can see in the 2-year yield, the 5-year yield up here in the upper right, the 10 in the lower left, and the 30 in the lower right, folks, what happened? It did nothing more than take these bonds back down to multi-decade support. And support is support until broken. And so what we want to then look for at the support line are these things making any type of reversal patterns? And inside those blue shaded areas, it's hard to tell from 30,000 foot, but they are, and we'll dig into it closer. And here's a closer look at just the 10-year. I like this quote in the upper left, folks. It said, the one lesson we've learned from history is that we've not learned any of history's lessons. And so just because, I've said it before and I'll say it again, just because a pattern has done certain things at a certain time, it doesn't have to do it again. The odds of patterns repeating almost exactly at multi-decade support or resistance lines may be low, but folks, if they do go to repeat, the impact most likely is big. And so this is a pretty simple chart, folks. This is taking the 10-year yield, flipping it on its head. See, I'm saving you. I could have turned this chart upside down, folks, but then you'd have to turn it the other way. You'd have to either turn your screen on your desk or your laptop upside down. So I'm doing you a favor looking at it this way. But this is the way bonds look. And so you can see a bullish falling wedge took place right here in 2000. And then once it broke above, stocks, they peaked and tanked as bonds took off. You see the same pattern in 07. And so here we've got this multi-decade support line, folks, taking place. You see a bullish falling wedge. And then I said, let's just drill down and look at the price action of late. It's kissed that support line, got a notch above it last week, and then particularly today. I was really surprised yesterday, folks. I was telling my wife, you know, that oftentimes, you know, how many times in our lives, if the Dow was up 200, 300, 400, 500 points, are bonds up? You know, and so that really wouldn't be the traditional teeter-totter effect. And so yesterday we did see a good rally in the stock indices, but bonds rallied too. And actually, you know, I got an alert that ZROZ, which is the zero coupon bond, was really moving, especially for a day like yesterday. And so bonds maybe are really sniffing. If you think about it, you know, bonds like economic weakness, folks. So bonds, in my opinion, are sniffing out weakness. And oftentimes stocks don't like that. So to me, this is a really, could be a big event that we could look back and say the first week of December, around the time of President Bush's funeral, we see this breakout in bonds. And so here's a look at actual bonds. Here's TLT. You can see that it looks like it tested support and potential double bottom here, try to fake out and then reversed. And then here's the move up. And this was earlier, so it didn't even reflect all of the big move that took place. You can see that TLT was oversold and it's moving higher. I just mentioned ZROZ. You can see right here at 1. It's still in a downtrend, obviously, because interest rates have been rising, bond prices have been falling. But as you can see right here, quite a move to the upside in ZROZ. And so if you're a long bond player and you don't want a coupon or you don't need the interest, you just want to play maximum roll the dice on price movement, folks, if you're right, you'll make you'd make like the least amount of money in IEF. That would be your short-term bond ETF, or AGG. If we are having a major decline in rates, then you might want to consider, I want some exposure a little bit on the longer side. So TLT would do that to you for the 20-year exposure. And then if you want maximum exposure, this is the 25-year zero coupon bond, which pays no interest at all. It's all a capital gain play. And so there's many different things, but these are definitely very interesting time for the bond market as far as looking positive at this time. So I want you to be really aware of, we covered the bank index earlier. I'm just looking at it also a little bit different way. But line 1 represents the 2007 highs, and then the 2018 highs kiss the underside of it. They've been rolling over this year, reflecting relative weakness versus the broad market. The broad market needs the banks, folks. You know, I'm not, you know, I truly believe that there are many components in our society today that are much better than 07 in the quote unquote financial crisis. We know we had really a lot of troubles in real estate. We had trouble in second mortgages. We had trouble in poor quality lending practices. So when you look at the average debt payment of the average individual in America, they definitely have less debt exposure than 11 years ago. Their debt service, fixed debt to their income is much lower, which is much healthier. The thing that, you know, folks, we got to really be humble and look at is back in 07, how many people really knew? I always remember when I'd express concerns to Sir John Templeton about this, or this, and he'd say, well, Chris, it's not that your concerns aren't warranted, but, you know, do you think anybody else in this world has the same concern, or in other words, they're aware of that same information causing those concerns? And I'm not that bright of a guy, folks. And, you know, so, you know, the answer was, well, of course, I'm not sharing anything new with you. And so John said, you know, what you got to be concerned about is that what is not built into this, you know, what you got to be concerned about is of knowing something that the majority or the minority doesn't know, and it's not reflected in the current prices. And so as we all, we got some really smart customers, and we appreciate your sharing. I know a lot of you are aware that people are talking about still excess debt levels in many different varieties out there. And so there can still be, despite certain parts of our debt structure, that we could say, this isn't 2007. So why do you reference the housing crisis and all of the financial crisis? And those are only labels, folks. The bottom line is prices are prices. We're back at the same level as 07. And if you know, the bank index was trying to get back into this rising channel that's been in existence for almost 20 years. Here's a rising support line that's been in play for 4 years. It's banging on the other side, not having a success. If banks break below rising support at 2, it's not projecting how deep anything can go, but again, this would be a break of support that would suggest you're going to gain purchasing power. You can probably buy banking stocks at much deeper or better prices if you'll just be patient. Just as a reminder, the AD line is one of the things that's not acting really poorly. There's a slight bullish divergence that's been taking place of late, that the AD line, you can see right here in the green, has actually created higher lows, and I didn't overlay it with the S&P, but while the S&P was making lower lows, I did share that in the, I believe it was the dashboards report last week, but there is a positive divergence taking place. But I want you to be from the Boy Scout perspective. Doesn't mean it is the holy, the line or the holy grail in the sand line, but if the February lows are taken out, I think the AD line would send a long-term message that certain parts of it, it's got some broken bones, you know, to it. It's very fragile. So again, really not a negative message coming from here, but if it did break the February lows, it would send definitely a concerning message. So I want to talk about the big banana, you know, right now, and it's just kind of something fun that it has to do with the metals market. And this is just something I've been working on that I wanted to share with all of you. But this is a look at silver going back into the 1970s. And so first I want you to just take your eyeball and run around the picture frame, or the black frame around here, and just really realize that this is nothing more than a 44-year trading range for silver, with a low at 350 at the bottom and a high at $50 at the top. And so you can see that it's double bottomed a couple of times down here in the lower left at the beginning. It double bottomed, you know, here in the 1990s. It also looks to double top from the 1990 high and the 2011 high, at about 50 bucks. So wide, obviously this is one of the wider trading ranges that any of us can find. Percentage wise, it's massive. But you'll notice that there's two shades, the blue and the green, and that represents essentially the mid-level line of this trading range. And so, whoops, sorry about that. So line 1 has represented some reversal here, another reversal here. That was a reversal low, a reversal high. Bang, 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 formed an ascending triangle here. So that took a couple of years, came back through it, and didn't just, it was like a hot knife through butter. It wasn't important then. But we'll notice we're back at that line 3 different times in the last few years, and we're back at it again. This line, folks, is a $14 level. And this line of reversals has taken place several times, as we can see, over 38 years. So when this is a monthly chart, if we would convert this to weekly, we could say this line's even been tested a lot more. And if we take it to daily, it was even a lot more than that. So to me, this is really fun. And why I say the big banana is we've got a real opportunity of some very large moves coming off this very key price point. And so I want to share with you Jekyll and Hyde analyses on silver, just from an aspect of taking one pattern and saying, well, let's take the opposite odds of the pattern. And so this is the same chart on silver, everyone, going back into the 70s. And as we all know, that a bearish descending triangle is formed by a series of flat bottoms and falling highs. So you can see flat bottoms, falling highs, flat bottoms, falling highs. Now, 2/3 of the time, this pattern breaks to the downside. And when the support breaks away, sellers say, not good, I've got to minimize my losses, and I'm getting out of here. But silver went against the trend. It bucked the odds. And you can see that it had a substantial rally that it didn't take long, folks, but that was 100%. And then this rally, you could have played it out for a while longer, but you know, it experienced a 50% rally. Once it broke from this pattern, it experienced a multi-100% rally. So silver it looks to be forming another bearish ascending triangle pattern. And so again, the odds would suggest that we have a breakdown here. But I want to just take the ball hat off and just think about, hey, we're open-minded and just play the game of what ifs. What if it breaks the traditional percentage? What do I do? What's my Boy Scout game plan? And then also on the next slide, what if it goes the other way? So we can see that not all bearish descending triangles resulted in falling prices. Actually, you know, this was a monster rally coming out of here. So silver's fallen for 7 years, made a base here over the last few years, and so it's really wedged between support and falling resistance. And so we're continuing to keep you updated on these patterns. But I just wanted to share, you know, from a 30,000-foot airplane, what this pattern looks like and what you would do on the upside. So if it would break out to the upside, if silver would break out, think about your risk spectrum, draw a line from left to right, 0 to 10 or whatever it happens to be. One of your most conservative plays in the middle of the market would be gold. That'd have the one of the lowest standard deviations being GLD. And then if you moved a little to the right on the line, you'd have SLV, you know, with silver. And then if you start moving up the line, you know, you could look at owning the senior miners, GDX. Then you can move up the line a little bit more in GDXJ. You can move up the line a little bit more and SIL, which is the silver miners. And then clear to the right side of that would be individual mining stocks, large. And then the next one to that would be individual mining stocks, small. So it's not about acquiring those positions right now. It's what would your game plan be if we start seeing surprise breakouts to the upside in the metals markets after them disappointing the metals bulls for 7 years. And so want to be open-minded. Again, the odds are this pattern is going to break down, but I want you to have a game plan that if we start seeing some positive action, you don't have to back the truck all up all at once, but where might you start getting your toes in the hot tub of water? So this is the bullish take on the descending triangles. Here's just a look at both ascending and descending triangles in silver that we played on the upside. You can see the bullish descending triangles took place at 1. At the 2011 high, we had a bearish descending triangle. The measured move, which is this blue arrow here, suggested that silver could have fallen 50% in value. It fell about 45 over the following 2 years. Here's the bearish descending triangle again that we just looked at. Again, the odds are favorable that this breaks out to the downside. And again, the measured move would suggest that if silver, which is currently trading around $14, if it breaks support, the measured move would suggest that it at least falls to below 10. So it'd be roughly a little bit less than that, almost a 40% decline in price. So to me, folks, this is the big banana as far as the first chart we look at, this one. This is looking at the mid level of a range. So we're testing now a 44-year range, the mid level where several inflection points have taken place. We have a compression here that could be a bullish breakout of a descending triangle could take place. Here's the odds, right here that the downside will take place. But the bottom line, folks, is either one is why I said the big banana is you slip on that thing and a lot of things could happen. And so if it slips above resistance, you can see a really nice rise. If it slips below support at 3, there's a good chance that you're going to be able to buy silver and probably have an increasing purchasing power of 40 to 50% by just watching things happen. Then if you're aggressive and you want to play that side of it, if it breaks the bottom of the descending triangle, there's not, to my knowledge, a single 1x inverse ETF silver with size and volume. So the play would be if you don't try to short futures or short ZSL. If you short ZSL, that's just a 1x ETF. That would be a good idea. ZSL would be the play if it breaks support at 3. But I really think as we look back, folks, on, these patterns were discussed in December of 2018. I really would guess, folks, we look at December of next year, 2 years out of December of 2020, that there will have been a really big opportunity in the metals complex to pick up money on volatility. So I want to just wrap things up. Appreciate your patience. Just a reminder now, folks, of big picture things. This is the spread between the S&P 500 and margin debt. I like this chart, folks, that they have inverted the margin debt. So when the spreads are wide, you can see here's 2000 at 1 and 2007 at 1. And when margin debt started shrinking, started contracting, where this fish mouth pattern narrowed, it was a negative for stocks. So you can see right now, this is the largest fish mouth pattern between the 2 and 20 years. And as I've shared for months and months, the margin debt by itself being high hasn't been the issue in the past. It's when society had a boatload of money on margin debt and they said, I don't like it and I'm selling my debt. So they're having to liquidate positions, which creates selling pressure in the market. So this does not mean that the sideways trading range in the market has to break to the downside. This just does add fuel to the fire, folks, that if the support range would break, these things could contract a lot. And so far, with a spread this wide, very few, which is none, long-term bull markets have ever gotten started. In other words, from current levels like this, 3 to 5 years out, the S&P's never made any kind of braggable gains. Another look at big picture valuations. Here's the Buffett indicator, which is taking, we talked about how much debt's in society. This is the total value of corporate equities to the debt they have. And so you can see at the top, corporate equities divided by gross domestic product, does not involve the debt. So it's a divisor of the two. And you can see nice long-term chart over 6 decades. You can see that here was a 2000 high, and other than like the last year above 1999, we are at levels not seen in decades and in decades. And so typically your great values come in down here on the lower side, and frustrating marketplaces with little upside action take place when this Buffett indicator is this high. So again, folks, this doesn't have to do with technical analysis, but what I've tried to share for you with you for months and months, with this heavy resistance ahead, this is a bad place for selling to get started for the long-term bullish case. You know, when you don't want to see things happen, this is the levels that we've been sharing for months and months. That's a really concerning place for selling to get started. Another one that is really contrary, but I don't think it's that tough to understand. The top line is the S&P 500, and the bottom line is the Conference Board's consumer confidence. And the bottom line is good confidence is good. Probably your neighbors, your mom and dad, your kids, your neighbors, co-workers, they're probably doing well if the consumer confidence is high, and they're probably feeling fairly confident. But that's a time when you should look at your portfolio and say, this confidence is probably built into the market. So historically, good confidence is not good for stocks in the long run. It actually is a time that you want to look at harvesting. And when your neighbors, your mom and dad, your kids, your coworkers are struggling or pessimistic, you have a greater likelihood that that's where you can load up and buy investments at a good price. So as we get close to the end here, just kind of wanted to do a reminder of the twin peaks that have taken place in 2007 and 9. Just a reminder that in the spring of the year, the S&P was at a new high. It came back down and then created a nominal new high into the fall of the year as monthly momentum had a negative or a bearish divergence taking place. It formed a bearish rising wedge, and once support was broke here in 2000, you can see what happened. 2007 was walking and quacking and smelling very much like 2000. You can see falling divergence, falling momentum, a bearish divergence that was taking place above. You can see a nominal new high again took place into the fall of the year. And it's still crazy, folks, but you know, when you think about it, that the 2007 highs both took place within a couple of weeks of the first day of fall, you know, which is September the 21st. And this week, if you look at weekly charts, folks, got any clue what was the highest weekly closing of the S&P this year? What week did that happen? This year it happened on 9/21. So I've been sharing these turning dates for years, for like 15 years with people, and I think this is the first time that so far a weekly closing high or low took place exactly on the first day of spring or fall. So with monthly momentum still really high and long-term support off the 2009 lows in play, if this support line and the February lows are taken out, there's a good chance you can buy stocks at quite a bit better price. So this is just something I shared last month. It's again just a reminder. It's the Dow going back 5 decades on the top. It's the yields, and the bottom line is the last time that yields were touching falling resistance in 2000, the Dow was at the top of this channel. You can see in 2007 it didn't quite make it to the top, but yields did. And so now we have the Dow facing a 50-year channel resistance and yields facing multi-decade resistance at the same time. And this is why I just tried to share. This was from a month ago, but just as a reminder, if rates happen to fall, I think it increases the likelihood that you can buy stocks cheaper in the future. One of the things as I finish up that kind of surprised me today was despite the market being off $600 or $700, folks, this is the S&P on the bottom, and this is the VIX on the top. You can see this is a decent move in the VIX right here. You know, on a percentage basis, it's nothing to laugh about from 15 to 20. It's about a 30% increase. But right now, my observation is you have a series of falling highs in the VIX, which if you draw a line here at the bottom, I didn't, folks, that kind of looks like a bearish descending triangle. And then if you flip the S&P around and you think, well, there's flat highs and rising bottoms, there's actually a bullish ascending triangle. So the S&P is testing support. The VIX is testing resistance at 1. So it's going to be really interesting. I was really surprised not to see fear go up more was my main point that I was wanting to show this chart today. You know, that people were actually, I don't know if it has to do with the markets being closed tomorrow in the funeral or if that's just total speculation, and the value of that idea is nothing. But the bottom line is if support breaks at 1 at the S&P and the VIX breaks out, I bet the S&P heads back to the lows of the 1st of October pretty quickly. So here's the game plan that I want to share with you. To me, cash is the most important thing. It's always fun and cool. I've done it many times, and sometimes it doesn't work as well, or it doesn't work also. But making money when the stocks are declining, it's great. You're really gaining purchasing power over the stock market. So for those of you that are open-minded to inverse plays in the market, I just want to share a game plan. This chart was shared in the sectors report that came out yesterday. This is the look at the inverse Russell ETF RWM. And there's a chance that it's forming an inverse head and shoulders. We shorted it earlier this year, then took some profits as it was getting near resistance. It's chopped sideways for a few months, but my game plan is to repurchase RWM if it breaks out above the 43.72 resistance level at 1. Regardless, this does look like a potential inverse head and shoulders is forming, incomplete right shoulder. Regardless of this pattern, the 43.72 level is resistance for RWM. So if it would break above there, I would look to be a repurchaser or an owner of this short-term ETF. But right now, I don't want to pick it up until we see that breakout. Then continuing on the same theme, if you're have more interest or just another position in the short side, this would be looking at shorting tech. So this is PSQ. So it looks like we had a breakout of a bullish falling wedge. It came up and hit some resistance, and it's come back down, and looks like it's testing old resistance as new support, and this red line is its 200-day moving average. So if you're a believer in influences of moving averages, or just a believer that some key turning points can take place, you'll notice that it's been a long time, a couple years, since the NASDAQ is above its 200-day moving average. So that sends a positive for this inverse ETF. And so to me, the key price level would be around the 33.80 level there here at 2, that if we'd see a breakout here, as we see, if the broad market starts breaking below the lows of this year, and we see breakouts in either RWM on the prior page here, or we see a breakout here in PSQ, those would signal that stocks are probably going to be weaker, and you can prosper from these inverse funds. So I still, again, want to share that from like 2000 to 2007-09, when the markets fell really hard, your main key is to avoid the decline and gain the purchasing power. There's nothing wrong with shorting it whatsoever. I will continue to show those plays, but the action, and especially in today's world, we saw it in 2007 to 9. There was some really violent reversals that if you didn't time your short right, you actually were right in thinking about what to do, but it was very easy to lose on the execution side due to high volatility. So you really want to plan these things out well. Again, if the market does sell off quite a bit, just think right now we're already able to buy, 20-25% more of Apple shares than just a few weeks back. So there's nothing wrong with gaining purchasing power, knowing your game plan, taking that cash and buying up fun assets, on sale. So we just sent this also today or yesterday in the sectors report, but just a reminder today that I've got alerts set. These are the stocks that have done typically well in the month of December over the last 10 years. So just a reminder that I sent out a separate email for this. It was also included in the sectors report. I've created charts on these, and I have alerts that if we see positive broad market action and upside breakouts, very open-minded to buy these typically strong stocks in the month of December. So I want to thank you for your membership. It's been to me, a very exciting year, to really be able to help people and try to share some really quality ideas on where you should be in your patience levels, cash levels, and assets allocations. So in that way, I know that can be boring, but folks, just like the 161 level when the market went sideways for 20 months, when you look back at a 50% rally, what was that? That was just an opportunity to be patient, let it build a base, and then know your game plan and hop on the long side. And we really had made a lot of hay on the upside in that strong rally, and then we've backed off again. So as we shared earlier, it's been a tough year for a lot of asset allocations, and we hope that we've been really beneficial to say just be really cautious, and that's probably your best advice. So again, folks, love you for your membership. Appreciate all of your feedback that you have. We're always trying our best, at this end. So I wish all of you happy holidays, and with some really important levels in the market coming up. If we see some certain breaks take place, we'll pull out a webinar mid-month if it needs be. So all the best. Happy holidays, everyone.